Hello and welcome to BloombergQuint. The festive season was an important marker in trying to judge the recovery of the economy from the COVID crisis. Indications are that at least the top income segments of the economy were spending well. Presumably that starts to filter through into segments where repair is still very much work in progress. Joining us to talk us through how he sees the economy, Neelkanth Mishra of Credit Suisse. Neelkanth, thank you so much for your time. Appreciate you speaking to us.
No, thank you, Ira. Thank you for inviting me. Pleasure to be here.
Okay, I'm actually going to start with something that you'd written about a month back and just sort of fast forward it to what you're seeing now. I think you'd written in the Times of India the activity at the aggregate level, and then beyond that, what it suggested in terms of the nuances. Even at that point, I think it was mid-October, you said that activity levels are looking better than what would have been assumed, by forecasts, etc. Since then, the indicators you track, particularly over the festive season, what have they pointed to you in terms of demand conditions in the economy?
Yeah, so far it's all very good. In fact, it is far better than expected. It is surprisingly close to the pre-pandemic path, right? So if you assume that FY20 in real terms was 100, FY21 at 6.5% growth would have been 106.5, 22 would have been 113, 23 would have been 121. As per the nowcast based on mobility, we already seem to be at 115. So we are. The first big threshold for most economies is how quickly can the economy recover its past level. The second threshold is, can we get back to the pre-pandemic trajectory? And on a run rate basis, at least based on the mobility data, we seem to be hitting that. And it is corroborated by the fact that the companies are also reporting very strong 2-year CAGR volume growth, and a lot of that momentum has actually continued into October. Talking to companies that deal with construction, it seems that a lot of the pent-up infrastructure capex that state governments had to do, you must have observed that there's some 4.5-5 trillion, that is 5 lakh crores of cash that governments have with the RBI. So that spending is also, there is some evidence of on the ground spending. So overall, the momentum looks very good. There is a but, and you may have anticipated that the but was coming. The rise in energy costs globally, right? So oil prices, gas prices, coal prices, edible oil prices. That is a $40-45 billion annualized headwind to the economy, right? So you're suddenly paying that much more than you were 2-3 months back. And so the pace of incremental positive surprise should start to slow. And I think you're starting to see that in the market as well. October was the first month in 6 that the Indian equities significantly underperformed global equities.
And I'll get to each of those in a minute. So on the consumption demand side, is it still very much that, say, the top 10 % of income earners is what is driving demand, or is it now starting to sort of filter through? I think you wrote in your article as to that spending then further leads to transfer in terms of income earning ability of some of the lower income segments. Is that process sort of repair at least underway, if not complete?
Absolutely. I think that is very much underway. What is, before we get into the process, I think just some observation. A lot of the demand for the bottom 50% of the economy is non-discretionary, right? And so that doesn't change too much. The discretionary element of the bottom 50%'s consumption basket is a very small percentage of overall GDP. For sustainable GDP growth, it is not as important as the rich starting to spend, either in buying new houses or buying new cars if they're available, or just spending on travel and tourism. But the fact that now international travel is picking up, right? So 15 November onwards, I think they're free to arrive. A lot of these bilateral negotiations are clearing up. Foreign international tourism in gross terms is 1% of GDP. Railways travel is picking up, so that automatically, if you visualize, means that the coolies have jobs, the small eateries that are outside every railway station for travelers, they start getting jobs. So that healing process is very much on. But in terms of incremental momentum to the economy, that's not more than 1-2%.
Okay. The energy hit that you're talking about, so there, of course, it's a global story. It's playing out here as well. To some extent, that hit got negated from these tax cuts. I mean, that passes from the consumption side to the other end.
Yes. So while we've all been celebrating the jump in tax collection for the government, and just to state that for your viewers, in the first half, the central government got 56% of full year budget as receipts. The 24-year average is 40%. So there is a 16% of full year number, which is excess in the first half itself. So while that's an excellent indicator of an underlying economic strength, but it's also a drag, right? So this is fiscal tightening, and so that the government chose to push it more towards and just cushion some of the pressures because of the energy cost headwind. But that's only about half of it. So the cost in terms of excise duty reduction is about 1.1 trillion rupees. In our estimate, it's very hard to do that accurately, but basically the various states that have cut their VATs is about 0.4 trillion again. So that's 1.5 trillion. So about $20 billion. So half of the energy cost headwind has been sort of absorbed by this fiscal sort of rerouting. So you were collecting more taxes somewhere, you sort of pushed it here. But I think the bigger impact, and I know you are going to come to it in any macro discussion, inflation is very important, is that it starts to at least moderate some of the buildup of inflation expectations. You know that inflation expectations are not as well understood as some of us would like to pretend. So in some markets it could be the onion price, some market it could be the petrol price, some markets it could be something else. And the fact that almost everyone was starting to say महंगाई बढ़ गई है, that there is an inflation. So I think that was building up. The fact that the headline numbers are down by 10-15 rupees on the fuel pump should at least help to taper some of that expectation. That also, in my view, was perhaps a driver for the government's decision.
Coming to that in a minute. So, just to sort of wrap up the demand side of the story. So what we are saying is that the upside that was coming in from, pent-up demand, if you want to call it, forced savings, whatever, that has more or less played through the system. The income side is going to be a far sort of, income upside story is going to be a far longer term story, may not even play out as, one would want it to, because except for certain areas in which employment seems to be, picking up, or, wages seem to be picking up, it doesn't seem like it could be an economy-wide story right now. So net, you have flattening out of the pent-up demand story and then some hit from the energy side.
I wouldn't call it, there is a pent-up demand, but remember that this recession was a very different recession from what you and I have been used to modeling, right? So past recessions have been because some real estate bubble burst, or like some NBFC failed, and there was like a 2-year drag on credit because people were not trusting financial firms, and therefore financial firms were not trusting people. So this was a very different type of a recession. You'd stop people from working, now they're coming back and working. So on a flow of income basis, this is not expected to be. I mean, I didn't expect it to be have a very large sustained impact on the run rate of income generation. So I was less worried about it. The only uncertainty was that will the surplus savings of the rich households, will it start to flow or not? Yes, they've been flowing. When this fades, will there be a noticeable drop in economic momentum? I don't think so. Okay. But one thing that we need to be very clear about, and some companies have started to observe this, it's unclear how much of that is because of the energy cost headwind, how much of that is because of the unseasonal rains in October, and which damaged a lot of standing crop. But some companies are already starting to talk about that incremental momentum is weakening. Now, what is unclear is how much of that is the second derivative. Because see, if you're here and you were here earlier, there will be a phase for several months where there's exhilarating acceleration, right? But as you come close to, you start asymptoting to that earlier curve, the pace of improvement will obviously has to slow. I mean, economy cannot keep flying, right?
Yes.
So I think we are reaching that point because as we come close to the pre-pandemic path, obviously the pace of improvement will slow, and I think we are reaching that point.
Okay, yeah, that was exactly my point. That is, the pace starts to sort of flatten out a little bit, as should be expected. Then you start to talk about drivers for the next cycle potentially, right?
Yes.
And whether it's income, whether it's a sort of employment cycle, which I don't know if there's enough evidence to suggest that it's an economy-wide employment, job growth, wage growth cycle that we are ready for or not, or is it a far slower sort of first government-driven, then some small private capex coming in, which then has its potential beneficial impacts.
So the fact that the central government spending, at least on infrastructure, has been surprisingly robust, right? So even in FY21, the kilometers of national highways built was up 23% year on year, like last fiscal year, and in the first half this year, again spending is up. So the central government spending on highways is strong. Railways capex was also for the full year expected to go up. I think in the first half, the allocations have been higher. It's very hard to track that on the ground, whether that's been spent or not. Because, as you know, the central budget is more, money given to that ministry, and whether the ministry has spent it or not, it's very hard to get. But at the state level, I must say that spending is well below where it should have been in the first half, right? Because the governments generally struggle to do work from home, right? Not everyone has computers, not everyone, and many of the systems are around physical files. So the processing of documents, the processing of projects, or even visualizing new projects, because the governments work on, okay, this year's budget had these projects, you can't think of anything new, right? And that's how the governments work. So now is the time, and that is the one big stimulus that I expect the economy to see as we hit the second half, which is generally stronger for government spending. They are sitting on a lot of spare cash, and they haven't spent much in the first half. So I think that by itself could add another 0.5%, 1% to the GDP run rate.
Okay, understood. Allow me to just switch focus to the inflation side of things first locally and then globally as well. How are you analyzing what's happening on the inflation side? I mean, I know headline numbers are okay right now. It's just really difficult to try and understand what's going on. If there are underlying pressures and if demand is strengthening, there is enough reason to fear that inflation could get out of hand. Or is there not? Because credit is not really picking up. So that's the other counterpoint, that there isn't that huge impetus that should push inflation. How are you even analyzing what's happening locally?
Yeah, so I would also.
That's a throw off my hands question and let you answer.
Yes, exactly. I also feel like doing that. Unfortunately, we need to at least have an opinion. And I must say that. If you see, so there is a global part and there's a local part. We'll come to the local part, right? Let's see the global part. In the global part, global end goods demand is not as strong as what some of these inflation indicators and port congestion seem to suggest, right? So we have a global goods demand proxy, like retail. It's consumption demand. Of course, there is also investment demand, which I don't think is very strong too. Outside of the US, or other than the US, almost every market is either at trend or below trend. In particular, goods demand in China, which is now a very large part of global goods demand, is actually quite weak, right? So it's well below trend. And it's also not showing any signs of improvement, right? So the end demand for goods, which you would expect would be the first sign of sustained inflation, is not that strong. That's point one. The second thing is that as the economies open up, now, vaccination globally is doing very well. And there are economies like India where the natural immunity through infection itself is now high enough. So things are open. So many parts, like the energy ecosystem, is now coming close to the pre-pandemic level. Now, think about the marginal producer of gas or oil or coal, who for 18 to 24 months had been seeing subdued demand and was actually forced to cut production or just close the mine. Now, you need to get them back, right? So you were you were at 100, you came down to 85 in the first wave of lockdowns, you went up to 93, 94. Now you are at 99 or maybe even 100. And now that production needs to come back. Now that guy is sitting and wondering, I have seen this story before. I was forced to lay off people, cut down, book losses, pay mothballing costs, and I had to shut down my mine or field or whatever. I'm not going to come in. You need to show that producer sustained high prices for that production to come back. Now, this is very different from the 2007-8 period where there was no spare capacity, right? So that was the time when China was booming, India was booming, emerging markets were booming everywhere. GDP growth was 4-5%, even the developed markets. And suddenly there was a shortage of oil and there were not enough fields developed. So oil had to go to 150. This is a point at which you need to give a price signal which is large enough for the supply to hit. And we are starting to see that. So what happened in India was, I guess, more administrative and seasonal, meaning that as rains ended, coal India production went up. But what you're seeing in China is that coal prices are like coming down every day. And so at least my expectation is that a lot of this tightness in global energy markets is just waiting for that last mile supply to come in. And that supply will not come in very smoothly, right? It could just be some country grandstanding that I want this, otherwise I won't raise production. But finally they give in and say, let's make money. And so economic incentives kick in. There is a third aspect to that, which is the supply chain bullwhip angle, which I've been making on our steel call for a while. So in the first half, we were very bullish steel, and then we became very bearish steel. And that reality is that the further away you are from end demand, the more volatile the demand seems to be, right? So the apparent demand growth for steel is far in excess of the growth in end demand for steel. Like, if car production is not happening, if global housing construction is slow, who needs the steel? No one. It's just that it was there was a few cuts last year, and then steel came short. Everyone, and then it sort of feeds on itself. It's like stock markets. I'm sure you'll have questions on that too. So it's the same, and I think that's correcting. So you must have seen global iron ore went to 230. So if you ask anyone, auto company, construction company, real estate developer, equipment companies, they're all complaining about high price of steel. But look at what's happening in China. In the last 2 weeks, steel prices have fallen $100, right? Iron ore is now down to 83. The futures for iron ore in January are 83. Just remember, they were 230 just 6-7 months back. Look at coking coal. Look at thermal coal. Look at on the tech side, where the volatility is the highest, look at DRAM, right? Memory, NAND or DRAM, and there are two types of memory, right? Or look at panel prices, like the stuff that, the notebook monitor, the handset or the TV. So those panels basically cut out of the same sheet. Those prices are also falling. So everything that is commodity and upstream is starting to ease. So which gives me comfort that some of the goods inflation trends that we are seeing are not likely to sustain. And one last point on that, even the freight congestions, right? So there's been a lot of noise about, and very validly, that there is a shortage of containers, there's a shortage of container ships. And what that did was it intensified the bullwhip. So what we found was that in the month of September, exports from China to the US were up 11% month on month. On average, they used to be up 2% month on month. So if you are a retailer in the US and you are trying to prepare inventory for Thanksgiving or Christmas sales, and you are told that, look, the lead time has gone from 20 days to 40 days. So you bring forward your orders. So what happens to the manufacturer? That guy just starts pulling his hair out and says, well, ab kya? How can I do this? And October, the decline month on month is much worse than seasonal, right? And which is why it's not surprising that container ship leasing rates or the freight rates are starting to fall off very sharply. You must have seen BDI, the Baltic Dry Index, has halved over the last 1.5 months. That's because of coal and iron ore. On the container ship side as well, there is a steep decline. So I think this is somewhat temporary. What we need to be, though, very careful about is US inflation. Wherever you have $3 to $4 trillion of pent-up savings, right? And you have these kind of congestions developing, and people start to bring forward their purchasing. If I was buying toys for my nephews or nieces for Christmas, instead of buying them in November, I would buy them in October. It was milega nahi, I mean, whether you find it or not. So that I think, these are 2-3 things that we need to look out for. If the US consumer remains very robust, then perhaps the inflationary numbers look stronger. US services inflation also needs to be watched because that's clearly something that as the economies open up, we'll have to see how much, and then the risk of inflation expectation getting reset. I don't see that happening in our neck of the woods.
Okay. So locally then, the energy price sort of story or the goods inflation story you think is starting to peak?
Yes.
Okay. And there are no local sort of incipient inflation pressures.
Oh, yeah. So don't get me started on onion prices. So what happens? So for the third year in a row, the monsoon's withdrawal was late.
Yeah.
Right. Thankfully, this time we did not have a destruction of onion crops in August and September, and the October onion crop is a minor crop. I mean, it's not very large, so it got destroyed. The standing paddy crop got destroyed in large parts of UP, Bihar, and in the northern belt, and perhaps I think even in the south. And a lot of the fresh vegetables. I think some potatoes also got destroyed. So you would have, if you're doing your grocery shopping, you would have observed that all green vegetables are up. Tomatoes are at 60 rupees. And so there has been destruction. But most of these are short cycle crops. And as the rains now thankfully are over, and by December and January, so there will be, I think, 2 months of inflation surprises on the fresh vegetable side. But then again, I think things should start to ease.
But we won't get into a sort of scenario where we need to do very aggressive monetary tightening kind of,
I don't see that.
Like it's at bay right now. But what is the potential in here, sort of moving towards the equity markets a little bit? Is the potential for surprise from US inflation and US rates still significant from an equity market perspective right now?
I think so. So I think the risk is there. I don't know if if there is. So every portfolio manager that I talk to is talking about it.
Yeah.
Right. That can US inflation, and so it's at the back of everyone's mind. It may not be at the back of the retail investors' mind because we have to be very cognizant that a very large part of trading volume is actually coming from the retail investor, and therefore the market as a whole could still get surprised if things were to worsen in the US in terms of inflation trends. But one quick addition to the previous response on the monetary policy side, see, if you are back to the pre-pandemic trend, right, not just big pandemic level, but pre-pandemic trend, then monetary conditions need to be normalized.
You're
right?
not locally.
Locally, yeah. So so aggressive tightening is perhaps not warranted because that will kill the recovery.
Yeah.
But I think the normalization should be expected.
What do you mean when you say normalization?
All the steps taken after, say, January 2020, in terms of, say, reverse repo cuts, some of the LTROs, etc. I think a lot of those steps now perhaps need to be sort of wound down. How quickly is the question, but if the economy is back at pre-pandemic levels, then those steps are not necessary. I must say though that the market, at least on the 10-year bond yield side, is running well ahead of what the monetary authorities have been signaling, in the sense that the official stance is still accommodative, but the 10-year bond yield is back to where it was pre-COVID.
So you suspect that even if they start to say normalize liquidity, raise reverse repo, even if repo is still some time away, the reaction on the bond market will not be that extreme because they've already built in some of that, is what you're saying.
Correct.
Okay. What is the fear on the liquidity side? Do you think it could start to lead to sort of issues, mispricing? Because they haven't started the process. I know they've started the process of normalizing cost of liquidity, but not the quantum by any means. You fear that there could be mispricing that could come in if this is allowed to persist for a while?
Let's first get it clear that the liquidity surplus is not of the RBI, is not intentional from the RBI.
Yeah.
It's part of the impossible trinity, right? That if you have a BOP surplus, see, if there is 10-12 trillion rupees of liquidity, excess liquidity, and anyway you used to have 1.5-2 trillion rupees, so say 8-10 trillion rupees of excess liquidity, and you have increased your foreign currency reserves by intervening in the currency markets by say $170 billion. That's an easy 12-13 trillion rupees of excess money you've been forced to print. So one of the things that this energy price does is that the increase does is that it wipes out the BOP surplus.
Yeah.
So the pace at which the RBI needs to intervene to keep the rupee from appreciating, of course, sort of moderates. And while you did say that credit growth is not picking up, at the margin, credit growth is starting to revive, right? Yeah. And one hopes that, because in our financials day, so we had a whole bunch of financial companies present at our financial day, and many firms are now starting to talk about getting some pricing power. So clearly, and so whether that leads to NIM stabilizing or not, time will tell. But the fact that they are starting to find pricing power in some parts of the market is a sign that credit demand is also picking up. So that should moderate the liquidity side. Will that moderate the excesses in some pockets of the equity market is hard to say, because that's classic crowd behavior modeling. That if there are a large number of people who haven't even seen a 10% drawdown and have seen steadily more speculative bets become successful, right? So you take a bet on the futures market, massively leveraged, and it works. And then you double the bet and it works again because the market just hasn't fallen. So the behavior that induces in people's minds is of excessive risk taking. And I see signs of that. And on moderate drawdowns, that behavior doesn't change. And therefore, and remember that last quarter, as per our estimate in September quarter, LIC net sold $12 billion, right? So they've been doing the counterbalancing act either deliberately or because of some other factor. But and what that means is that a very sharp reduction in the stock market looks unlikely. I do think that it will flatten out. It's very expensive now. But what that means is that the liquidity excesses or the symptoms of liquidity excesses that we see in the equity markets may not fade away very quickly.
I'll throw in two questions on the equity markets from Neeraj, although I had one more on bonds. Maybe I'll get to it at the end. So what are the risks to your mind from an equity market standpoint? Is it more global? Is it, like you said, sort of valuations locally? Is it, heavy political calendar coming up locally as well? What are the risks to your mind to the local equity side?
Yeah, so I think it is primarily global. Because I think the potential volatility that can be induced by some concern on growth. Because see, right now we are at that stage where all economies are opening up, and new sectors of the economy as they light up, the overall momentum looks very strong. The quarter-on-quarter momentum numbers are very robust, but there is still no evidence of the underlying demand or how strong the underlying demand trend is, right? So it's just an opening up trade. And my fear is that the underlying demand trends are actually not very strong, right? So there are, so if say the Chinese real estate market is going through a correction, and even the $3-4 trillion of excess savings that you see in the US are all concentrated for the rich. So that just means that it will mean more investment in assets rather than more consumption, because the rich really can't spend more. I mean, how many more yachts are you going to buy? So the point is that the global growth are becoming an issue. So, for example, if say iron ore prices are at 80, suppose coking coal keeps correcting, and if steel prices have to fall to $650, there will be a very visible reduction in profit numbers for many of our Indian steel names, right? We've already seen some of the oil producers, coal companies, the stocks have started to come down. And so as that starts to happen, I think new parts of the economy can start exposing some different types of stress. So I see that as a risk, a global risk. Domestically, yes, valuations are so high. In fact, we have been talking about significant upgrades to FY23 GDP for a while. I mean, almost a year now, and the market is kind of starting to price it in. But even if that was to happen, suppose FY23 GDP consensus is bumped up by say 4 to 5%, and FY23 Nifty EPS is bumped up by 10%, right? And in parallel, assuming growth rates are the same, FY24 also goes up by 10%. 1 year from now, so if you are standing in November 2022, and Nifty stays at 18,000 levels, it would still be one standard deviation ahead of its average. So it is really expensive even after you built in a 10% upgrade to earnings. So that means that a lot of the growth surprise is actually priced in. And I fear that the market may flatline as a whole. Within the market, of course, there are cyclicals who will do better. Some of the safety names will start to taper off. But at the market as a whole may flatline for the next 12 months.
And within the market, is there a sort of clear division in your head on whether you're moving towards the capex plays or sort of the tech-heavy, businesses, even though they may be very, very expensive?
Yeah. So we are very much focused on the cyclical recovery aspect. So we've been overweight financials and industrials, and to some extent some of the car names that. Of course, we were badly underperforming for a while. Thankfully, the last 2-3 months, we have done a lot better. And we were overweight tech all of last year. Early this year, perhaps 3 months too early, we cut our weights on tech. We should have waited another 3-4 months. But thankfully, that call is working as well. And see, my expectation is that the tech names will keep doing well. Right? I don't think from a top line perspective, the businesses will do badly. Software is eating the world and there are no other places for finding engineers, right? So India is already at 4.5 million people. It's the largest number of software developers in the world. Now it is larger than the US. If the number of software developers in the world has to expand meaningfully in the next 10 years, where will you find them, right? I mean, most of the East European countries have 200,000, 300,000 people. Here we can easily double it, right? So that volume growth, whether it is captive centers and all that will happen. The problem is that their workforce will see multiple demands on them, meaning in terms of the attrition levels and margins and all that. And therefore, I don't think that the P multiples being at 30-35 times forward is actually likely to sustain, right? So once the volume growth stops surprising positively, it will sustain. I'm not saying it will fall to 2%, but if it stops surprising positively, I think the PE multiples will very quickly come off. On the other hand, as evidence of credit growth picks up, and you have seen that in some of the bank numbers, which reported good numbers in September, and that's a very early stage of the cycle, right? I mean, over the next 3 to 4 years, I expect that to pick up very meaningfully from here.
And on commodities, I know you detailed your view a little earlier, but from being bullish to cautious, where are you on sort of the commodity names right now?
Oh, we're actually very bearish. Again, perhaps we downgraded too early. So we downgraded about end of May. We should have waited till end of July. But I mean, you can't time everything perfectly. But no, I would be very worried. The last time Chinese real estate prices fell 5%, 2015, steel prices globally had fallen to $300. Right? I'm not saying that will be repeated, but if the pace of construction, look at what is happening to Chinese steel production, right? And that's what people were bullish on. That look, Chinese steel production is falling, pollution control, this, that, and that's so fantastic for Indian steel names, and because we have iron ore and all that. look at what has happened. The demand has fallen even more. And despite those production cuts, Chinese steel prices are still falling. And iron ore is correcting, and coking coal is correcting. And I think that whole so it's finally cost plus, right? So if iron ore is not 230 but 80, and coking coal is not say 400 but say 150 or 200, automatically steel prices need to be at 600. So and whether the Indian demand should be fine, but the prices are set globally. So we are very bearish. In fact, there could be significant upside to these names. The downside to the names.
Okay. Neelkanth, I'll leave it at that. I think I've taken more time than you penciled in for us. But thanks so much for taking the time to speak to us on all things economy, markets. Appreciate your time.
Thank you, Ira. Thanks for having me.
Thanks for watching.